All right, so here is a disclaimer for today's presentation. The information presenting is just a general information for accounting. So no one can become accountant in an hour. And our goal today is to help small business owners to get a basic understanding of accounting process and how to use the financial statements to help manage your business. So if you get confused somewhere in the middle of the presentation, don't worry about it. As Ronnie said, you can use the chat to post your question, and we'll have a Q&A session by the end. You may also schedule a one-on-one appointment with SBDC later to discuss your specific accounting issues. So most business owners are not accounting professionals. However, as Warren Buffett said, accounting is a language for business. We need to be comfortable with accounting to really understand the business performance. So what is accounting? Accounting is a process of recording, reporting, interpreting, and analyzing the financial information pertaining to a business. The accounting statements are used both internally and externally. Internally, business owners and management team need accurate accounting reports to make relevant business decisions. Externally, banks and investors rely on the company's historical financial statements and the business forecast to decide whether or not to grant a business loan or to invest in your business in exchange for a percentage of ownership. Accounting has many areas. For example, financial accounting, cost accounting, and taxation. For large companies, they usually have different departments handling these areas. It's impossible for small business though. But as a small business owner, we need to know the basic to better understand our business and also to facilitate the communication with external partners. Useful accounting information needs to be relevant, reliable, comparable, and also consistent. In order to achieve these goals, all accounting practice need to follow certain rules. So as we discussed, accounting is a process to recording and reporting financial data of a business. Some people get confused with bookkeeping and accounting service. They may appear to be the same profession, but they actually focus on different tasks of the whole accounting process. So in general, bookkeeping is responsible for categorizing and recording financial transactions. And accounting is responsible for interpreting and reporting the financial data. With the help of accounting softwares, the process is much easier compared with the pencil and paper era. Most of the time, bookkeepers can generate financial reporting without any issue. So in today's workshop, we're going to focus on the bookkeeping process and also how to interpret a financial statement. The main job of bookkeeping is to record financial transactions following accounting rules. It is not exciting, but crucially important. Only with proper bookkeeping, companies are able to track all financial information to make key decisions. The typical bookkeeping process includes 7 steps as listed here. These are the prerequisites to generate relevant and reliable financial statements. So now let's discuss these 7 steps one by one. The first step of bookkeeping is to separate your business and personal finance to ensure they are not mixed together, so it's clear to IRS what your business is earning and how much tax you are liable to the government. If your business is an LLC or a corporation, you must open a separate business account. If you're a sole proprietor, it's not legally required to open a business bank account, but it's strongly recommended. Having a separate business account allows you to easily monitor your business transactions and help to organize your accounting records. It also helps to establish your business credit rating. Banks, other lenders, and suppliers rely on business credit reports to access the credit worthiness of a company. And a strong business credit will increase your chance to access the business funding you need. The second step of bookkeeping is to choose between a single entry or double entry bookkeeping method. The single entry bookkeeping is similar to maintaining a checkbook, and you just record transactions when they happen. Here's an example. So in this single entry bookkeeping, you have a list of the date, the details of each transaction, the dollar amount, either an income or expense, and also the impact of these transactions to your bank balance. For sole proprietors with no inventory, no employee, and no intention to apply for business loans, you can probably use the single entry method. If your business is complex, the double entry bookkeeping should be a right one for you. It tracks where the cash is from and where it goes. With a double entry bookkeeping, each financial transaction is recorded using 2 corresponding entries called a debit and a credit, and the dollar amount for each debit always equal to the corresponding credit. For example, if you purchase an office furniture for $1,500, the double entry record looks like this. It demonstrates that you paid out cash of $1,500 and received a furniture asset at the same time and for the same value. Remember that if you use accounting software for your bookkeeping and accounting work, you automatically chose the double entry accounting method. The next step of bookkeeping is to choose either a cash-based or accrual-based accounting method. So with a cash-based method, the sales revenue is recorded when you receive cash payments from customers, and expense is recorded when cash is paid out to your suppliers or employees. With the accrual-based accounting method, revenue is recognized when earned, not necessarily received, and expense is recorded when incurred, not necessarily paid. So as we can see, the difference between these 2 methods is the timing to recognize revenue and expense. Per the general accepted accounting principle, usually called GAAP, all public traded companies in the US must use the accrual-based accounting. For private business with annual revenue below $25 million, you can choose between cash-based or accrual-based accounting method. So please talk with your accountant to decide which method is better for your business. Now, let's use an example to demonstrate the impact of these two methods on your financial reporting. So in this example, Company A provides IT service worth $5,000 to customer B on December 15, 2020. A sent an invoice of $5,000 to B and required payment within 30 days. On December 5th, 2021, B paid A $5,000 for the service received. So if Company A used cash-based accounting method, there's no transactions booked on December 15th, 2020. On January 5th, A will book a journal entry to recognize revenue and cash received, $5,000. If they use the accrual base, however, on December 15th, A would recognize revenue for the service they provided and also book $5,000 to account receivable. And on January 5th, when they receive the cash, they would recognize cash received and then offset the account receivable. Which means if they use the accrual basis, they need to post 2 journal entries for the transactions for the service they offered. So in the accrual base, if after offset these 2 accounting receivables, the impact is the same. However, the revenue was recorded at different time. For the cash base, A recognized service revenue on January 5th. With accrual base, they recognize the service revenue on December 15th, 2020. So because of the time difference, it impacts the revenue for either 2020 or 2021, which also impact the company's tax liability. The cash-based method is easy to understand, but it doesn't show either the customer's liability to your business or your company's liability to others. As a result, the cash-based method cannot offer a whole picture of your sales and expense and might limit you from making more predictive decisions for your business. Accrual-based accounting is more popular and offer more detailed insight of your company's financial position. So either way, please talk with your accountant to evaluate which method is better for you. The first step of bookkeeping is to select a bookkeeping system. You definitely can do it manually with a Microsoft Excel file. If you do consider to use any accounting software, you have options such as the QuickBooks Desktop, the QuickBooks Online, Xero, or Wave. These softwares are for both bookkeeping and financial reporting. Keep in mind, you may need help from your accountant to set up your business account in the system. So now we discussed the first 4 steps for the bookkeeping. Those steps are preparation works. The routine bookkeeping that you should do every month starts with a source document gathering. The source documents are original records containing details of transactions, for example, invoice, receipts, or a business loan statement. This document should have date, buyer-seller details, the dollar amount, and also the product and service provided. These are the information you need to book any transaction. In today's online world, most people do not keep physical copies of this document anymore. Instead, we can save them to a computer hard drive or put them to the cloud-based online document storage. We do not need to provide this source document when filing for tax return, but we need to keep them in case the business gets audited by IRS. The current rule is we need to keep this document and records for 3 years from the dates that you file your original tax return. But there are some exceptions that give IRS 6 years or longer for auditing. So most lawyers and accountants recommend to keep the original document for 7 years. The core of bookkeeping is to classify each transaction into specific categories, depending on the transaction's business purpose. There are 5 main categories that transactions can fall into: the asset, liability, equity, revenue, and expense. The asset refers to resources that have some future economic benefit, such as cash, inventory, and equipment. Liabilities are future obligations. For example, you collect sales tax on behalf of the state government. Those are the liability that you need to submit the cash to the government. Equity is the owner's interest. It increases with revenue and capital contribution and decreases with expense and distribution. Revenue is generated mainly from the sales and product and service. And expense is the cost incurred to generate revenue and to operate your business. So if you use accounting software for bookkeeping, when setting up your business account, the system automatically creates a chart of account based on your industry. You can add new account if needed. So now we can use QuickBooks Online to demonstrate. So now we're in the QuickBooks Online system. And as we said, when you create your, when you create the account, the system will automatically generate a chart of account. So in this chart of account, the first column is a list of the account you may use to book transactions. And the second column, the type, represents the 5 categories that each account falls into. So for example, we have the asset, liability, equity, income, and expense. So in this chart of account, there's only one checking account. So for example, if you have 2 bank accounts for your business and you want to separate them to get a clear picture of your business operation, you can create new accounts here. So for example, you have one account with Capital One. You can use Capital One and also the last 4 digits of your account number. And you can create another with Bank of America. So this way, you actually added 2 new accounts to the system, and you can use them to book your business-related transactions. The last step of the bookkeeping is reconciliation. So a good bookkeeper classify transactions, book transactions, and also reconcile those transactions to ensure everything is correctly accounted for. The reconciliation is the process of matching transaction on your base statement, such as the bank statements and credit card statements, to the transactions reported. It helps to catch any possible double booking or missed transactions. So again, this process you can do manually or use accounting software to complete. With all the 7 steps of bookkeeping done, we now can generate a financial statement. There are 3 major financial statements: the balance sheet, income statement, and cash flow. The balance sheet reports a company's assets, liability, and share owners' equity. It's also called a statement of financial positions. This statement gives a snapshot of a company's financial at a particular moment and summarizes every transaction since your company launched. The income statement is also called a profit and loss statement, and it contains revenue and expense transactions incurred in a given period of time. A cash flow statement summarizes cash flow in and flow out of a business. It has 3 components: cash from operation, cash from financing, and cash from investment. The cash flow statement shows how transactions in the balance sheet and income statement affect a company's cash status. So some people get confused with income statement and cash flow statement. These two actually measure the business from different perspectives. The income statement measures the profitability of a business, and the cash flow statement measures the solvency. Sometimes being profitable doesn't necessarily mean that you have sufficient cash to run the business, and that's why we need both. The goal of a healthy business is to be profitable and also have sufficient cash flow to meet the expense and the liability needs. Now, let's go through this statement one by one to explain how to read and interpret data on each statement. A balance sheet helps to get a whole picture of the company, the value of the business, how much you owe others, and how much is left over for the owner. A balance sheet is a must-have if you want to speak with an investor to ensure a loan or to sell your business. It contains 3 parts: asset, liability, and owner's equity. A balance sheet must balance which means the whole value of the asset has to equal the whole value of the liability plus the owner's equity. So, for example, this is a typical balance sheet. First of all, the asset value has to equal to the value of liability and owner's equity. For the asset part, the asset is ordered in terms of liquidity or how long it usually takes to convert the asset to cash. So as we can see here, cash is always the first asset item, followed by other current assets such as accounts receivable and inventory. Long-term assets such as property and equipment are listed after the current asset. The order of liability is similar. Current liability first, followed by long-term liability. The current liability refers to debt due within 12 months, which may include account payable, wage payable, and credit card debt. Long-term liability may include any business loans you have. The owner's equity is the last part of the balance sheet, and it shows the ownership or the net book value of this business. Another major financial statement is the income statement. Here, this is a simplified flow of income statement. The purpose of the income statement is to show the profit or loss that a business generates in certain time period. It also shows the gross and operating margin of a business, which is also important to identify any possible issues and to optimize business operation. So in this example, the first component of the income statement is revenue, which is the product and service sold in certain period of time. In this case, it's from January to December 2020. The next item is the cost of goods sold, which are the direct material and labor expense associated with a product or service sold. The difference between revenue and cost of goods sold is a gross profit. Other business-related expense are usually called SG&A. The selling, general, and administration expense are listed below the gross profit. Subtracting the SG&A from the gross profit generates the net operating profit. Some other miscellaneous income or expense may also incur during this time period, and the net income at the bottom is the amount that you should pay tax for. All right, now let's play with the show me the money statement, the cash flow statement. A cash flow statement tracks the cash coming in and going out of your business. So with a positive cash flow, you have more cash coming in to your business. And with a negative cash flow, you are spending more than you make. If you're out of cash, you could go out of business even if the income statement shows the business is profitable. So how could this happen? For example, you make a revenue of $100,000 in a month, Of this 100K, only 20K are cash sales, and the other 80K are credit sales, which means you send invoice to your customers for later payment. If you cannot collect this 80K before you need the cash to pay off business-related expense, you are in cash trouble. The cash flow statement is made up of 3 sections: operating, financing, and investing. Operating cash flow is the cash activity related to performing the regular and ongoing activity of your business. Cash flow from financing relates to capital raising activities such as borrowing money from a bank and any business loan repayment. Cash flow from investing are all the cash activities related to a business investment. Let's go to an example. So in this example, first, if we skip down to the summary, we can see the actual change of cash for this year or for this covered period is a positive 69K, which changed the company's cash status from 15 to 85K. Now let's go to the major line to get a better picture where this 69K come from. So as we can see, most of the cash come from the product and service sales. Deducting all the operating expense from this cash inflow, we get a net cash flow from operating of 147K. So this is actually a cash inflow, it's a positive impact. From the investing activity area, we can see that the company sold old equipment, but also spent 75K on vehicle for business use. So in total, these 2 activities cost a net flow of 41K. It's an outflow of business from the company. The last section is the financial activity. The business got a business loan, which represents a cash inflow to the business, but also has a loan repayment and also dividend to its owners. Here it's a net outflow from the cash, from the financing activity. So if we add net cash flow from these 3 sessions, we get the total change in cash of the 69K. Also remember, in the cash flow statement, in the summary area, the ending cash balance need to match with your bank statement. If it doesn't match, there must be a mistake and you need to recheck your recording and reconciliation. So all these 3 financial statements that we discussed are equally important, and we need to analyze all of them to get a whole picture of the business financial position and operation. This is especially important for business merger and acquisition. But these statements do have limitations. One big limitation is that everything is booked at historical value, or we say at cost. So for example, you bought a property for your business. On your balance sheet, the property is shown as an asset with the purchase value minus any depreciation over the years. However, the market value of this property might be much higher, and it will not be recognized until the property is sold. So because of this, before making any important decisions, please consider to talk with your business advisor or your accountant. Generating financial statements sounds very complicated, but it's actually very convenient with accounting software. If interested, you may go to the QuickBooks Online test drive to familiar yourself with the system. So let's go to the test drive for some demonstration. So here, after posting transaction records to the system, you may go to the reports section. So here you can easily generate the 3 statements that we discussed and even customize the report for your need. For example, we can generate a balance sheet. So this balance sheet is for February 11, 2021. And if you like, you can create a balance sheet comparison report. To do that, you can choose a period to compare for, and then run report. So this is a demonstration for a company with historical data. You will also have data in the compared column, and you can see what is the change of your asset, liability, and the net value of your business. It's the same for income statement, profit and loss. And you can run the profit loss for any time period you choose. So for example, January 1st, 2020 to the end of the year, and generates the report. So this is income statement for the whole year of 2020. And you can customize this report to show only the customers that you want to see the result. So basically, you can customize the report any way you like. So some other reports are available also. For example, you can run this account receivable aging report. With this report, you get a list of all the customers that you have added to the system, and also the balance due or overdue for each of them. So you can follow up with your customers for payment. QuickBooks offers different plans, so you can choose based on the complexity of your business and also the functions you need. If you are a SBDC client, you can receive more offer from QuickBooks. The current offer they can give us is a 1 month free and then 50 off for 12 months for new QuickBooks Online customers. So this is basically the presentation today. So as we said, these are very general information for accounting. And if you have any questions or concerns, please contact us to schedule an appointment. We definitely can go through your accounting issues or questions and concerns.